You know what nobody's talking about right now? The fact that the entire precious metals pricing system just cracked wide open. And I'm not being dramatic here. Something fundamental just shifted in how gold and silver are priced. And if you don't understand what's happening, you're about to watch one of the biggest wealth transfers in modern history happen right in front of you. Let me explain what I mean by the physical market broke the paper price. For decades, the price you see when you look up gold or silver, that number flashing on your screen, that's not actually the price of physical metal. It's the price of paper contracts. Futures contracts traded on exchanges like the COMEX in New York. These are promises to deliver metal at some point in the future. And here's the thing. Most of these contracts never result in actual metal changing hands. They're just bets on the price, speculation, paper shuffling. The system worked like this. Banks and institutions would trade massive volumes of these paper contracts, and that trading activity would set the spot price that everyone references. Meanwhile, the actual physical metal, the stuff you can hold in your hand, would trade at roughly the same price, maybe with a small premium to cover manufacturing and shipping costs. But something just broke. Physical gold and silver are now trading at premiums so far above the paper price that the entire pricing mechanism is falling apart. We're not talking about normal premiums here. We're talking about premiums that suggest the paper price has completely lost touch with reality. Let me give you some numbers to show you how extreme this has gotten. Silver Eagles from the US Mint, they're selling for $8 to $10 over spot. That's not unusual by itself. But here's what is unusual. Try to actually buy physical silver at spot price. Go ahead. Call a dealer. Try to find 1,000-ounce bars at the COMEX price. You can't. They don't exist at that price. The spread between what silver is worth, according to the paper market, and what you actually have to pay to own physical silver has blown out to levels we haven't seen since the supply crisis a few years back. And it's not getting better. It's getting worse. Gold's doing the same thing, just less dramatically. But when you're talking about a market as large and liquid as gold, even small premiums represent enormous dislocations. Sovereign mints can't keep up with demand. Delivery times are stretching out, and the people who actually need physical metal for industrial use or central bank reserves, they're paying whatever it takes to get it. Now, why does this matter? Why should you care about some technical pricing mechanism? Because this is how price discovery breaks down. And when price discovery breaks down in a market this important, the correction is violent. Think about what the paper market actually is. It's a leverage game. For every ounce of physical gold that exists in COMEX warehouses, there are dozens of paper claims on that gold, maybe hundreds. The exact ratio is hard to pin down because the reporting is opaque, but estimates range from 100 to 1 all the way up to 500 to 1 in silver. That works fine as long as everyone's playing the paper game, as long as people are happy to settle in cash instead of demanding physical delivery. But the moment people start asking for the actual metal, the moment they stop trusting the paper, the whole thing implodes. And that's exactly what's starting to happen. Look at what's happening in the COMEX warehouses. Registered silver, that's the silver that's actually available for delivery against futures contracts, has been draining steadily. We're talking about a market that's supposed to be the global price-setting mechanism for silver, and the actual physical inventory is at levels that would cover maybe a few days of global industrial demand. Think about that. The exchange that sets the price for the entire world has almost no metal. It's like discovering that the bank that issues your currency has no gold in the vault. Oh wait, that actually happened. That's exactly what happened when Nixon closed the gold window in 1971. Foreign governments kept showing up asking to exchange their dollars for gold, and eventually the US said, "Sorry, we're out." We're watching the same thing happen in real time with the paper precious metals market. Here's where it gets really interesting. The big institutions know this. Central banks know this. That's why they've been accumulating physical gold at the fastest pace in decades. They're not buying paper gold. They're not buying ETFs. They're buying physical bars and storing them in their own vaults. China's been doing this for years. Russia did it aggressively before sanctions cut them off from Western markets. Now you're seeing countries like Poland, Hungary, Singapore, India, all building up physical reserves. They're not stupid. They can see the same thing you and I can see. The paper market is a house of cards. And here's what nobody wants to say out loud. When this breaks, when the paper price finally loses all credibility and people demand physical settlement, there is no price high enough to clear the market. Because the metal doesn't exist. Not in the quantities that have been promised. You know what happens in a market when demand massively exceeds supply and there's no way to increase production quickly? The price goes vertical, not up. Vertical. We saw a preview of this during the supply disruptions a few years back. Premiums on silver coins hit $15 over spot. Some products were completely unavailable at any price, and that was just a temporary supply chain issue. Imagine what happens when the entire pricing mechanism breaks down. Let me paint you a picture of what this looks like in practice. You're a manufacturer. You need silver for your products, solar panels, electronics, medical devices, whatever. You've been buying silver based on the COMEX price plus a small premium. That's how you budget. That's how you plan. Suddenly, you can't get silver at that price anymore. Your suppliers are telling you there's a 6-month wait, or they want double the spot price, or they're just not taking new orders. What do? You pay whatever it takes. Because if you don't have silver, you can't manufacture your products. You can't fulfill your contracts. Your business stops. Now multiply that across every industry that uses silver. Every manufacturer, every mint, every industrial user. They're all competing for a limited supply of physical metal. And they're all willing to pay more than the paper price because the paper price is meaningless if you can't actually get metal at that price. That's how you get a price spike that makes previous bull markets look tame. And gold. Gold's even more interesting because of its role in the financial system. Central banks hold gold as a reserve asset. It's the only asset on their balance sheet that isn't someone else's liability. It's the ultimate form of money. And right now they're buying it as fast as they can get it. But here's the thing. There's only so much gold available for sale. Annual mine production is around 3,000 tons. Recycling adds maybe another 1,000 tons. That's it. That's the entire supply available to meet new demand. Central banks alone bought over 1,000 tons last year. If they keep buying at that pace, and if private investors start buying aggressively, and if industrial demand stays strong, where does the gold come from? It comes from higher prices, high enough prices to shake gold out of private hands, high enough to make people sell their jewelry, their coins, their bars, high enough to make mining companies ramp up production, even though that takes years. But here's what makes this different from previous bull markets. This time, the paper market might not be able to suppress the price. In previous cycles, whenever gold or silver started to run, the big banks would dump massive amounts of paper contracts on the futures market. Doesn't matter if they had the physical metal or not. They'd just sell paper, drive the price down, trigger stop losses, shake out the weak hands, and reset the market. That playbook doesn't work anymore when people stop trusting the paper. When buyers say, "I don't want your paper contract, I want physical metal," the whole game changes. You can't print physical gold. You can't create physical silver out of thin air. The laws of physics apply, and that's exactly what's happening right now. The premium on physical over paper is the market's way of saying, we don't trust the paper price anymore. Now, I want to take a quick detour here because this affects a lot of people watching this. If you're sitting on retirement accounts, 401ks, IRAs, that kind of thing, and you're watching this unfold, you might be wondering how you can actually get exposure to physical precious metals inside those accounts, because buying coins or bars directly doesn't work with the tax structure of retirement accounts. I put together a free guide that walks through exactly how gold IRAs work, how you can roll over existing retirement funds into physical gold without triggering taxes or penalties, what the rules are, what the costs look like, how the storage works. It's in the description below. If you've got 6 figures or more in retirement accounts and you're thinking about this stuff, it's worth checking out. All right, back to what's happening in the market. Let's talk about what this looks like from the perspective of the people who are short these paper contracts. There are banks and institutions that have sold massive amounts of paper gold and silver. They've promised to deliver metal they don't have, betting that they can either buy it later at a lower price or just settle in cash. That's the game. But what happens when the buyers stop accepting cash settlement? What happens when they demand physical delivery? The shorts have to go into the physical market and buy metal, real metal, at whatever price they can get it. And if there's not enough metal available, if the premiums are already blown out, they're trapped. This is what's called a short squeeze. And in a market where the short position is potentially hundreds of times larger than the available physical supply, a squeeze doesn't just push prices higher, it breaks the market. We've seen this before in other commodities. Remember nickel on the London Metal Exchange? The price went from $30,000 a ton to $100,000 a ton in 2 days because of a short squeeze. The exchange had to halt trading and cancel trades because the situation was so extreme. That was nickel, an industrial metal with relatively limited financial importance. Now imagine that happening in gold or silver, metals that are central to the global financial system, metals that central banks hold as reserves. metals that are seen as the ultimate safe haven. The implications are staggering. Here's another angle most people aren't considering: the derivative exposure. Banks don't just trade physical and futures. They trade options, swaps, forwards, all kinds of derivative contracts based on precious metals prices. The notional value of these derivatives is in the trillions, with a T. These derivatives are priced based on the paper market, based on the assumption that the COMEX price is real and reliable. But if the paper price loses credibility, if physical and paper completely decouple, what happens to all those derivatives? They become impossible to price, impossible to hedge. Counterparty risk explodes. You get a derivatives crisis in precious metals that could make the 2008 mortgage crisis look simple by comparison. And the thing is, the people running these banks know this. They're not stupid. They understand the risk. But they're trapped in a game of chicken. Nobody wants to be the first one to blink. Nobody wants to be the one who covers their short position and drives the price higher, because that triggers everyone else to cover, and then it's a race for the exits. So they keep playing the game, keep selling paper, keep pretending the system is fine, until it's not. Let me give you a historical parallel that might help you understand where this is going. In 1980, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and silver futures, driving the price from $6 an ounce to $50 an ounce in a matter of months. The exchanges changed the rules mid-game, restricted trading, and forced liquidation. The Hunts went bankrupt, and silver crashed. But here's the difference. The Hunts were trying to manipulate the market. They were using leverage and speculation to drive prices artificially high. What's happening now is the opposite. The market is naturally trying to reprice based on physical reality, and the paper market is the artificial construct that's breaking down. You can't change the rules to fix this. You can't force people to accept paper when they want physical. You can't print gold or silver. The laws of supply and demand eventually win. And when they do, the repricing is going to be spectacular. Think about what gold and silver are actually worth in a world where the paper market has lost credibility, where the only price that matters is the physical price, where central banks are competing with private investors and industrial users for a limited supply. Gold at $3,000? $5,000? $10,000? Those numbers start to look conservative when you consider the amount of currency that's been created, the amount of debt in the system, the amount of paper claims on physical metal. Silver's even more extreme because of the industrial demand component. Silver's not just a monetary metal. It's essential for solar panels, electronics, medical applications, water purification. You can't run a modern economy without it. And if the price spikes because of a shortage in the investment market, that affects every industry that uses silver. We're talking about a scenario where silver could go from $30 an ounce to $100 or $200 or higher. Not because of speculation, but because that's what it actually takes to balance supply and demand when the paper market is no longer suppressing the price. Now I know what some of you are thinking. This sounds too extreme. The authorities won't let this happen. They'll intervene. Maybe. But how? They can't print gold or silver. They can change trading rules on the exchanges, but that doesn't create physical metal. They can try to jawbone the market, but words don't satisfy industrial demand or central bank buying. The only real solution is higher prices, high enough to reduce demand and increase supply. And that process is going to be painful for anyone who's short or who needs these metals for industrial use. Here's what I think is going to happen, and I want to be clear that this is speculation based on what I'm seeing in the market. The premiums on physical are going to keep widening. More and more people are going to realize that the paper price is meaningless. Demand for physical is going to overwhelm available supply. Dealers are going to run out of inventory. Mints are going to have multi-month backlogs. At some point, probably during a moment of financial stress or geopolitical crisis, someone big is going to demand physical delivery on a large futures position. Maybe a sovereign wealth fund, maybe a central bank, maybe a large institution that actually needs the metal. The shorts won't be able to deliver. They'll try to settle in cash. The buyer will refuse. The exchange will be forced to either find the metal or declare a default. And that's when the paper market breaks completely. The price will gap up, not gradually. Overnight, you'll wake up one morning and gold will be up $500. Silver will be up $15. And that will just be the beginning. The media will call it a bubble. They'll say it's irrational. They'll interview economists who explain why precious metals are a barbarous relic and this can't last. But it won't be a bubble. It'll be a repricing, a recognition that the paper price was always artificial and the physical price is what matters. And here's the really important part. Once that repricing happens, it doesn't go back. Because you can't rebuild trust in a paper market that's already failed. Once people know that the paper contracts aren't backed by real metal, they don't go back to trusting them. Look at what happened with the dollar and gold in 1971. Once Nixon closed the gold window and admitted the U.S. couldn't deliver gold at $35 an ounce, the price never went back to $35. It went to $200, then $800, and now we're over $2,000 because the trust was broken. The same thing is about to happen with the paper precious metals market. Now, let's talk about what this means for you personally. If you own physical gold or silver, you're positioned for what's coming. Your metal is going to reprice to reflect physical reality rather than paper manipulation. That's good news. If you own paper gold or silver, ETFs, futures contracts, mining stocks, you need to understand the counterparty risk. When the paper market breaks, not all paper claims are going to be honored. Some ETFs might not actually have the metal they claim to have. Some futures contracts might settle in cash at prices that don't reflect the physical market. Physical in your possession is the only way to eliminate counterparty risk. If you don't own any precious metals, you need to ask yourself, do I want to buy before or after the repricing? Because once the paper market breaks, you're not going to be able to buy at these prices anymore. The premiums are already telling you that. And if you're thinking, I'll wait and see what happens, understand that by the time it's obvious to everyone, it's too late. The metal will be gone. The premiums will be astronomical. You'll be trying to buy at the top of the panic instead of positioning yourself ahead of it. This is one of those rare moments in markets where you can see what's coming. The evidence is right there. The physical market is already breaking away from the paper price. The premiums are screaming that something's wrong. Central banks are buying as fast as they can. The question is, are you going to pay attention to what the market is telling you, or are you going to wait until everyone else figures it out? Let me give you one more piece of evidence that this is real. The lease rates for gold and silver have gone negative at various points recently. That means people are willing to pay to borrow metal. Think about that. In a normal market, you get paid interest to lend out an asset. But in precious metals right now, the demand to borrow physical metal is so high that people are paying for the privilege. Why would anyone pay to borrow gold or silver? Because they're short, and they need to deliver physical metal to close out their position. Or because they need it for industrial use and can't get it any other way. Or because they want to lock in access to physical metal before it becomes even harder to get. Negative lease rates are a sign of extreme tightness in the physical market. They're a warning signal that the system is under stress. And it's not getting better. It's getting worse. The COMEX has already changed its rules multiple times to make it harder to demand physical delivery. They've increased margin requirements. They've limited position sizes. They've created financial incentives to settle in cash instead of taking delivery. Why would they do that if there wasn't a problem? If the warehouses were full of metal and everything was fine, they wouldn't need to discourage physical delivery. These rule changes are proof that the exchange knows the system is fragile. They're trying to prevent a run on the bank. But you can't prevent a run by making it harder to withdraw your money. That just makes people more nervous. Here's the bottom line. The physical precious metals market is in the process of breaking away from the paper price. This isn't a conspiracy theory. It's not speculation. It's happening right now. You can see it in the premiums. You can see it in the delivery delays. You can see it in the behavior of central banks and large institutions. The paper market has been suppressing the price of gold and silver for decades through leverage and manipulation. That system is breaking down because physical demand is overwhelming the available supply. When the break is complete, the repricing is going to be violent and swift. You have a choice to make. You can position yourself ahead of this, or you can wait and hope it doesn't happen. But understand that if you wait, you're betting against basic supply and demand. You're betting that somehow, magically, more physical metal is going to appear to satisfy all the paper claims. You're betting that central banks are going to stop buying. You're betting that industrial demand is going to collapse. That's not a bet I'd want to make. The smart money is already moving. They're buying physical. They're taking delivery. They're getting out of paper and into real assets. The premiums are telling you that. The lease rates are telling you that. The behavior of central banks is telling you that. The only question is, are you listening? Because when this breaks, when the paper market finally loses all credibility, and the physical price is the only price that matters, there's going to be a very clear line between the people who saw it coming and positioned themselves accordingly, and the people who waited too long and got caught on the wrong side of the biggest repricing in the history of precious metals markets. Which side of that line do you want to be on?